Fair Isaac Corporation, ticker FICO, has had an incredible run. It's been as low as $390 in the last 52 weeks and as high as 916. So some people doubled, nearly tripled their money if they were to get in on that low and get out at that high. But it currently sits at 892. We are coming up with a fair value right around 561, where our margin of safety would be closer to $400 would be the ideal value investor range, and then we'd want to reevaluate closer to $600. So it does look like it is very overvalued at this point. Earnings yield, you can see just how overvalued it is, 3.6. We really want that above 5 in this economy. We'd be looking for $44.50 to $47 in earnings per share, and the stock came in with 21.5 last year. 20 this year is expected. Cash flows, very, very good cash flows. 36.55% this year, up from the 31.55 it's historically been. They do not pay a dividend. They stopped a few years back, and it doesn't look like they're going to start paying it again. Return on equity is negative because they have a negative equity. Their liabilities are larger than their assets. It could be just accounting. If they're more towards the financial end, we'd have to actually dig into the balance sheet to look. The ROI, 21.65%, ROA of 25.9%. It all looks very good here. Debt to equity is negative because of that negative equity percentage. Gross profit, 78%, up from the 75 it's been. 27 on the net, up from 25. Most of the things here look great, aside from the balance sheet numbers. So revenue growth has been kind of slow, 3%, 4%, but analysts are expecting it to jump about 10% each year for the next 2 years. So we're plugging that into our thesis over here. What if they can continue that 10% for the next 3 to 5 years? Earnings per share growth have been really strong, but looking like they're slowing down. In fact, there's a dip from last year to this year, and then a bit of growth, jumping back to 5% next year. Cash flow growth is incredible. Share count, they've been buying back 5 to 9% of shares. So we're just going to go with a midpoint of 7, and that'll be a part of our thesis here. Although, if they have a good management team and they see just how incredibly overvalued the stock is, they should stop with the buybacks. And maybe if they do want to reward investors, in that case, do a special dividend or something. Assets are shrinking, so they are selling stuff off, 5 to 8%. So we're just going to say 6% shrinkage, and then liabilities growing 32.5 to 33.5. So we're just going to go with 33 here. Dividend non-existent. Margin, they aren't too consistent. They've gone from 18.3 to 29.8 to 27.1. So we are just going to say they have a little bit of margin growth, 1%. And with all of that, this is what we're looking at. If you can get in with a margin of safety of 30%, you'd be looking at the intrinsic value being 32% higher than where you're getting into the stock. So in fact, we could probably drop this down 25%. You're a little bit above the market value if you can get in at 420. And then 5 years, you'd be looking at outperforming the market by 12%, buying in at the 420 level with a 59% return or $332. And with this thesis here, we'd be looking at fetching 15.5%, which is really good. When the general market is 8 to 10% a year, 15% in some years could potentially double the market return. There are very good financials here. That doesn't look strange at all. The balance sheet, I really don't like what I'm seeing here, but we could dig deeper and really figure out why this is. but the assets are trending down and the tangible assets are becoming more and more negative every year. Liabilities are trending up, and so their tangible book value is trending even more negative, which is something that we really don't like. Free cash flow looks amazing, some really good growth here. And then the price. Here's how everything is trending. So clearly the balance sheet is getting worse and worse every single year, while other things are getting better. Earnings are trending way up above everything else, up to $800 this next year. But here is the current share price. So it's obvious that it's overvalued. It's probably set to pull back down. Ideally, between these here is what we'd want to see. We don't really want to see the share price floating way out above everything else on a stock that we're trying to buy into. So we're really looking for it to come down towards more of this $500 range at best for a decent deal. 560 would be a decent deal, but if you're getting in at 560, you're not getting the best returns, because what this decent deal is what the market says. Well, the market looks for almost a 30 PE on this stock, which is quite high, especially for the revenue growth that we look at. And that is the main driver of the value here. But most people are buying out into the future, and a value investor is looking at the current value and then accounting the futures on top of that. So that is what we are looking at for this stock. This one is definitely interesting. Things look incredible. Need to dig deeper into this balance sheet, but the price is so high at the moment that it's probably going to be a while. I mean, we'd have to wait until it gets down to at least the 560 to really have a reason to dig deep into it, because even at most that anyone should really be willing to pay for this would be 800 based off those earnings of next year. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks that we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.